Are you seeing any evidence that they're kind of pricing in volatility risk, either related to the impeachment or otherwise?
Sure. So I would say impeachment is absolutely an important political issue, but in terms of impact on the markets, I think the vast majority of clients that we talk to are much more focused on longer term issues. So I would say the theme that we're seeing on the option side is people are hedging. That's absolutely the number one theme, but the focus is actually on longer dated hedges. So most of the interest that we've seen is hedges going out 6 months to 1 year rather than to year end. So that suggests that people are looking past impeachment toward the economic outlook, toward the 2020 election. I would say those are the issues that are really driving markets, less so on the impeachment front.
And your interpretation of that, is it that, people are already building up this reservoir of concern that maybe can be relieved down the road? In other words, is it a contrarian indicator, or do you have to say, well, the markets really might be in for a rocky ride?
So it's interesting because if you look at the stock market, just on the surface, you say, oh, people are complacent because the market's back at all-time highs. But actually underneath the surface, especially positioning the derivatives market, it's very cautious. So one of the measures we look at looks at the difference between demand for puts versus calls, right? How much downside risk is being priced into the market. That measure spiked in August with the trade war escalation, but has stayed elevated throughout this entire past 2 months, even as markets have rallied back, even as VIX has come in. So I think positioning in the derivatives market is definitely more on the cautious side.
Mike, it's maybe we're thinking about the macro part of this, like how impeachment could actually affect the economy. And I think there's maybe two roads. One is a confidence road. Whatever you think about impeachment or not, the idea that there's a big process going on can't be good for confidence, I think. The other one is going to be concern about a change in the rules that would affect the market, right? Which is, would the tax cuts, the corporate tax cuts go away, ultimately leading to
You're talking about electoral implications.
Electoral implications. I think there's two roads. So, and it's uncertainty. Is it more uncertainty than we've lived under over the last several months? I don't know.
Well, Sameer, there you go. That is the question. I mean, how do you think the markets are set up heading into the final 3 months of the year? Big year-to-date gains, but pretty much sideways for a year right now, and similar valuations to a year ago, but with much lower bond yields.
Yeah, I mean, I think you nailed it, right? Is again, if everything goes right, at least from our standpoint, you just don't have a lot of upside in equities. Now, those bond yields are lower, but they're lower for a reason, right? They're lower because inflation expectations keep coming down. They're lower because growth expectations keep coming down. So from our standpoint, the bond market is definitely sending a signal. And the signal it's sending is that we keep getting later and later in this economic cycle. And the uncertainty, unfortunately, is only creeping up. Whether it's Brexit, we're about to kind of get to a deadline here, whether it's, the Democratic candidate for president, and then, how they square up against President Trump and the possibility of a new administration. So all those different things are kind of playing in. And at least right now, what we're advising clients is there's not a lot of upside if it all goes right. So kind of pull in those oars just a little bit.
So in other words, stay defensive right now. I mean, it's interesting. You talk about how the bond market seemingly is signaling end of cycle. We had kind of a sloppy bond auction in Japanese government debt this morning, and that seems to be why our yields are up. Wouldn't that suggest that it's the global yield environment that's kind of driving things, at least in part?
Oh, absolutely. Yeah. I mean, the yields are what's driving PEs on the stock side. They're also kind of impacting, how spreads are doing in terms of, staying kind of tight. But, as Mandy mentioned, as, some of the put call ratios haven't come down, you also haven't seen spreads go back to their tights for the cycle. So a lot of the markets are continuing to tell you that, again, this is probably a peak in the equity market. You're probably at a pretty good spot to kind of take some risk off the table. But you continue to see all those different things kind of tell you that you're a little bit long in the tooth.
Mandy, just quickly, we've been talking about how, 1 year ago to the day, essentially, the market was up 10% year to date for 2018. Yeah. And we obviously know that we had a nasty sell-off for the next 3 months. Do the conditions right now in terms of customer kind of hedging, positioning and things like that compare to last year?
So I think right now the positioning is lighter and it's more defensive, right? So, for example, we track net exposure of all the hedge funds on our prime brokerage side, and we're seeing net exposure toward the lows, lower than they were at the depth of the sell-off in Q4 last year. That tells you people are not as bullish this time around. We're not seeing the similar crowding in the tech names that we saw last year. So I think on the positive side, if you're looking for a way to be bullish in this market, I think the light positioning is definitely, the number one reason to be bullish. It's because everyone's expecting a sell-off. No one's positioned for the upside. That's when you can get the upside surprise.